If someone fails a driving test, we naturally assume they just can't drive. Right.
Yeah, obviously.
But what if the test itself was actually designed to, I don't know, change the way you steer? In our deep dive into prop trading challenge reviews today, we're seeing that genuinely good traders are failing. And not because they can't read a chart, but because the evaluation fundamentally distorts their natural behavior. Okay, let's unpack this. You plug your proven strategy into a prop firm evaluation and suddenly, boom, everything goes sideways.
Right, because, well, a prop trading challenge isn't actually a test of your profitability. It's primarily a test of rule management under pressure.
So the constraints themselves actually dictate your behavior.
Exactly. I mean, a firm can look incredibly attractive on the surface, but practically impossible once you get behind the wheel, simply because, their rules force you to abandon the exact discipline that made you profitable in the first place.
Okay, here's where it gets really interesting, because I'm looking at these profit targets, and basic math tells me an 8% target is, well, a lower bar than a 10% target.
Sure. Yeah, you'd think so.
Right. Like, why wouldn't I just take the 8% and run? But looking at our sources, taking the lowest target seems like a massive trap.
It is a huge trap because you're looking at the ceiling when you should really be looking at the floor. I mean, the profit target doesn't matter at all if the drawdown model knocks you out first.
Wait, so how does that actually work against you? I feel like people just assume a loss limit is just a loss limit, right?
Well, if a firm pairs a low target with a type trailing drawdown, it forces aggressive trading. It heavily punishes steady risk-managed systems. Think of static drawdown like a safety net on the ground. But trailing drawdown, that's a net that actively stalks you as you climb higher.
Oh, wow. So it's moving up with you.
Yep. If it trails your unrealized profit, the math just gets brutal. Imagine you're up, say, $4,000 in an open trade, but it dips back to $2,000 before you close it.
Okay, so you still made $2,000.
In a normal account, yes. But in a trailing model, that $2,000 dip might blow your entire account because that invisible floor moved up behind you while the trade was open.
That is wild. So a massive $100,000 account with a trailing rule might actually give you like less practical breathing room than a $50,000 account with a static drawdown that just stays put.
It completely changes the math, yeah. And it's not just the big drawdown limits that kill a strategy. It's the subtle rules that create friction and just erode your edge day by day.
Oh, like minimum trading days. I was actually going to ask about that because minimum trading days sound completely harmless to me. If I have to trade 5 days a week, so what?
Well, think about it. If your strategy typically generates, say, 3 high-probability setups a week, but the rules demand 5 minimum trading days, you are now being forced to make box-checking trades.
Oh, I see. You're taking subpar setups just to satisfy a rule.
Exactly. You're introducing completely unnecessary risk.
It's like telling a sniper they have to fire their weapon 3 times a week just to keep their license. Even if there's nothing to shoot at, it forces them to waste ammo and give away their position.
That is a perfect analogy. And then you add in other hidden frictions like strict no-news policies or overnight and weekend holding restrictions.
Which, if you're a macro or swing trader, those rules make the challenge entirely unusable.
Right. Then there's platform friction. Firms will advertise MT4, MT5, or cTrader.
But wait, is platform familiarity really a deal breaker? I mean, a chart is a chart, isn't it?
A chart is a chart, sure, but execution speed and error rates determine your profit. If you are used to one-click execution on cTrader and suddenly you have to navigate some clunky MT4 setup during high volatility...
That friction can consume your edge entirely.
Exactly.
Okay, so you've survived the stalking out of the trailing drawdown, you fired off your box-checking trades, navigated the platform friction, and hit your target. Now you just collect that shiny 90% profit split they advertise.
Yeah, not quite. That 90% split is just a headline number. If you actually want to see that money, you have to read the fine print on consistency rules.
Consistency rules, what do you mean?
A consistency rule allows a firm to dictate the shape of your success. Like, you might hit your target, but if one lucky trade made up 60% of your profits, the firm can disqualify you.
Because your wins weren't distributed evenly? That's insane.
Yep. They use it as a backdoor to deny your payout, which is why fast payout cycles and no consistency buffers matter far more than a high split.
Got it. So we are hunting for opaque rule language. Like, if you have to dig through a 40-page document to find their definition of drawdown or prohibited strategies, that's a massive red flag. So what does this all mean?
It means the best prop challenge isn't the one with the biggest advertised account or the cheapest entry fee.
Right, it's the one giving your specific trading method a fair runway.
Exactly. Before you buy any challenge, the ultimate question to ask is this: can your strategy survive their specific rules long enough to actually show its edge?
Which leaves you with something fascinating to think about. If arbitrary constraints in a trading challenge can fundamentally distort a trader's natural decision-making, forcing them to take bad risk just to check a box, well, how are the invisible rules and time constraints in your own daily work altering your true performance? Are you driving naturally or just trying to pass the test?